Now, how about the L Brands breakup into Victoria's Secret and Bath & Body Works? Now, we've liked L Brands only because, frankly, Matthew Boss likes it. He's the JP Morgan analyst who's the best in the business. And he included as one of his lag plays that we talked about, along with American Eagle, which is owned by my Travel Trust, and the Gap. His thesis was very simple. We adopted it. Bath & Body Works is a fabulous growth vehicle, and it would be better if L Brands would only spin off the struggling Victoria's Secret brand. Sure enough, that's exactly what the company decided to do this past February. Bath & Body Works had been roaring for a long time, especially last year when sales of soap and hand sanitizer went through the roof. Meanwhile, the deadbeat Victoria's Secret was a scandal-plagued mall retailer, couldn't seem to adjust to the 21st century. Now that they've broken up, Bath & Body Works is a high-quality retailer with a more expensive stock. Victoria's Secret's a turnaround play, much lower valuation. Let's take them one by one. With Victoria's Secret, you need to understand all the things that have been holding it back. Basically, they failed to adjust their strategy and their image to the modern era. I mean, they kept trying to sell sexy when that's not what their key demographic wants. They were trying to sell underwear to women with ads aimed at men. Plus, it sure didn't help that the former CEO of L Brands spent decades bankrolling Jeffrey Epstein. Yes, that Jeffrey Epstein, the one who definitely didn't kill himself in jail. Oh, one man's opinion. However, lately, Victoria's Secret has gotten religion and adjusted its marketing to actually appeal to its customers, not to men. Plus, they're up against some very easy comparisons versus last year because they weren't doing their job last year. Now, I'd be hesitant to give this one the benefit of the doubt, but the brilliant Matt Bross is extremely bullish in the stock, and it's at 66. He's got a $100 price target. Why? Because Victoria's Secret doesn't need to knock it out of the park. It just needs to show some modest improvements. The stock currently sells for just 9 times earnings, one of the cheapest retailers out there. I think the stock reflects all the problems, but none of the potential positives, which is what makes it so enticing. But let's go with the gem here, Bath & Body Works. I really like this one as a long-term investment, but there could be some short-term turbulence as the company's up against difficult comparisons because they made so much money last year. This business was able to thrive even when it was joined at the hip to the ailing Victoria's Secret. So I bet they can do much better on their own. At 15 times next year's earnings estimates, I'm calling it a steal.
Don't miss a second of Mad Money. Follow @Jim Cramer on Twitter. Have a question? Tweet Cramer. #MadTweets. Send Jim an email to madmoney@cnbc.com or give us a call at 1-800-743-CNBC. Miss something? Head to madmoney.cnbc.com.